Good morning, everyone. Welcome to our Kaplan pre-licensing. Today's webinar is going to be for an hour and a half. My name is Paul Rosen, transmitting to you from beautiful, sunny, gorgeous, 72 and sunny today, Dallas, Georgia. I have as my partner in crime my assistant, Nicole Turner, who will be my moderator. Any of you who've been on the call with us for the last 5 sessions, you know the routine already. So the reason that we're doing these webinars is that we understand many of you on the call had already taken a class or did an online course, and then due to the coronavirus, your testing site in your state had been closed down. So we're looking to provide some gratis services to our students, because here's the bottom line: without students, we don't have a school. So we want to try to help our students as best as we can. A little bit of a refresher on each topic. I'll be starting the webinar in approximately 7 minutes at 10:30. Today's webinar, because we have a lot of information today to go over on annuities and group insurance and taxation on life insurance products, retirement plans. So we got a lot of good stuff to share with you today. So that being the case, instead of me trying to talk real fast, I could sort of tap on the brakes a little bit, and we will go till 12 noon today. We'll be going to 12 noon. In fact, tomorrow's presentation as well will be the 12 noon, and then Friday will be 12 noon. The Wednesday, Thursday will be the regular 1 hour session. So grab your favorite beverage. Make sure it's not alcoholic, because we want you clear-headed here. So grab your coffee, your iced tea, or favorite beverage. If you haven't had your breakfast yet, bring your bagel or roll or your omelet with you, and we'll be starting up in 6 minutes. So we welcome you to the call. The call is going to be recorded, as they all have been. So anyone who's missed opportunity, I know had a couple people on Friday that on that LinkedIn linked up with LinkedIn or me. I don't know. They found me somehow. I'm not hard to find. And you know, they asked me a question, and you know, I said, well, they are going to be recorded. I said, oh wow, that's great, they're recorded. So we are going to record these sessions. So if you do miss anything, or you have to leave the session a little earlier, or if someone came on later and they missed some of the beginning of the session, you will have opportunity to review it. Kaplan has not actually put a window of time as far as how long you could review it, but for right now, there is no expiration at the moment. All right, that can change in the future. So I always say it's like me watching a Marx Brothers movie, or what I did last night, because there wasn't a heck of a lot on TV for me. You know, if I'm home with my wife, she's up in New York right now. I'm down here in Georgia, so she was watching, and my 2 daughters, who are both engaged, were watching. I think it was The Bachelor or Bachelorette, or one of those things. So I went on YouTube and I said, all right, what can I watch? So I was a big fan of Jack Lemmon, Walter Matthau, and Burgess Meredith. And if you remember the 2 movies that they were in, Grumpy Men and Grumpier Old Men, the end of the movie, they had some bloopers. I can't repeat them on the call here, but they had some bloopers on there, and really, they gave me a big belly laugh watching that. And then I was watching some of the old Johnny Carson reruns. If any of you are old like me, remember Johnny Carson late night TV show, where a lot of actors, actresses, comedians actually started their career on his show. Gave a lot of people their start. So on one of them, they had may he rest in peace, Robin Williams, and also may he rest in peace, Jonathan Winters, and both of them were on at the same time. So needless to say, it was quite chaotic watching, and it was a good time. So I had a nice evening, even though I'm by myself right now. I was able to watch fun things. So I know everyone is under a lot of pressure financially, emotionally, psychologically, mentally. Just take a big deep breath in. That's what I keep telling myself. I found one day on the weekend, Saturday, I was not doing so great myself. So I said, you know what? Let me just go outside. I went in my car and I just drove around. There's some beautiful areas in my area here. In fact, there's actually some horse farms. So, just as they say, chill out. Things will improve, I think, starting in May. And believe it or not, May 1st is this Friday. A week from this Friday, I'll be taking a ride up to Rising Fawn, Georgia. My partner in crime here, Nicole Turner, who's our moderator, she might not even know where Rising Fawn is. Rising Fawn is right at the Tennessee, northwest of where I am here in Dallas, Georgia. It's northwest Georgia, Tennessee line. And I'm going to be visiting with my new puppy dog, French Bulldog, that I've been saving up for. Yeah, I know I should go to the shelter, and I had been going to the shelter, but I don't know, all the shelters down here, they have a lot of pit bull mixes, and my wife said absolutely not, no pit bull mix. It was up to me. I have 10 dogs already here, but my wife is the boss always, so she says no. She said yes to the French Bulldog, so I'm going to meet our little French Bulldog, whose name is going to be Sylvia. And being that I'm going to be doing more classes online, virtual online, we've already been approved in about 5 to 6 states, and we're working on more and more approvals. So do watch your Kaplan emails from us, or go onto our website, kfeducation.com. We keep posting daily different things on there, and we will look to accommodate our students via the internet. And we are also going to be looking at areas that we were not in the past, where we might come in to provide virtual online learning. So lots of good things. I always believe where one door closes, another door opens. And I think it's smart that all of you are looking to get into insurance, because you know what? Regardless of the economy or environment or pandemic, people still need to have insurance. That's bottom line. People still die. People still need to plan for the future. People get sick. People get injured. So our insurance products are needed. In fact, probably they need them more than ever now. All right, it is 10:30. And you know what they say in show business? It is now showtime. So good morning, everyone. My name is Paul Rosen. I will be the presenter for our webinar number 6 of our 10-pack for life, accident, and sickness. We'll actually be getting into our life, accident, sickness presentations tomorrow. So this will be the last one for life insurance. Our presentation today is going to be for 90 minutes till 12 p.m. because we got a lot of good information here to share with you. My associate, Nicole Turner, will be the moderator. And if you have any questions, she'll be more than happy to answer any of you or all of your questions. Now, I do have another associate, Darlene London, but Darlene is not taking any questions, so please do not send Darlene any questions. She is just an observer here for our life, accident, and sickness today. All right, so if you have a question, send it over to Nicole, and Nicole will do her best to try to answer any and all of your questions. I will let the webinar go for another 5 minutes or so after our 12 o'clock end time to help Nicole get to as many people as she possibly can. The webinar is a free webinar, as you know, and we're going to be doing 4 more of them this week. I'm also providing the webinars for property casualty, and those webinars start at 4 o'clock p.m. today, Eastern Daylight Time, and we'll go to 5 o'clock. And we're doing these webinars as a token of our appreciation for our students. We understand that many of you had registered, took a Kaplan course, either a live classroom in a formal traditional classroom where you have a teacher in the front of a room, you were sitting as a student, or maybe you took one of our online pre-licensing self-study classes, and you did all your studying, you worked really hard, and now all of a sudden this coronavirus pandemic struck us like a brick of a ton of bricks, and now you were ready to go take your state exam, and either your appointment was canceled or you're not able to set up an appointment. Many of the venues will start opening. I know down in Georgia here, starting on Friday, they are going to start accepting reservations to schedule an appointment to take a test. So do check with your state administrator. PSI exams, Prometric, or down here in Georgia, it's Pearson VUE. Check with your administrator to see when they are going to reopen their doors, social distancing, and all the other good stuff, so that we continue to see the downtrend of the number of new cases and number of people dying as well from this terrible virus. So today's webinar is going to be on annuities, retirement plans, taxation, and we'll talk a little bit about group insurance as well. So let's begin here. We're going to talk about annuities. So Nicole, just let me know that my slides are changing. Just send me a quick text message that I'm good here. It should be. We've been doing this enough times here. Yeah, she says we're good, so we're good. Okay. We've muted everyone on the call, so this way we don't hear any crying babies, toilets flushing, screaming, yelling, or fire engines. Someone we hear in the background here. So let's. So Nicole, could you mute someone who came on the call? Because I hear them. I hear background here. Okay, so everyone is now muted on the call. Like I said, if you have a question, Nicole will be more than happy to answer your question via chat. Okay. So up until this point, last week, we were talking all about life insurance. And the purpose of a life insurance policy is a life insurance policy protects against the risk I hear someone still there. I don't know why. I hear some background still, Nicole. So if you could just mute them all. Okay, thank you. All right, any of you on the call, if you're calling in on a phone and you're not using your computer, or if you are using your computer and you're logging in, if you'd kindly just mute your microphone or shut your microphone on your computer or your phone, so this way we don't get any background here. So we've been talking up until this point about life insurance, and what life insurance protects against is the risk of dying too soon. Well, an annuity does just the opposite. An annuity protects against the risk of living too long. Many of my contemporaries, I'm 63 years old, many of my contemporaries are concerned that will I wind up outliving my money? And what an annuity can do is protect against that risk of not letting your money outlive you. And even for the younger people, I have two daughters. My younger daughter is going to be 25 this year. My older one's going to be 29 this year. And both of them are saying, you know, Dad, I'm wondering, I'm paying into Social Security. Will Social Security be there for me when I want to retire one day? Of which I raised my kids that when they were still living at home, take 50% of your paycheck, put it into a savings account, and forget that you got paid that money. So they've always listened to dad's good advice, and they have some savings. So thankfully, all of them are working right now, but let's say they're not. So the annuity protects against our risk of living too long. What's the definition of an annuity? An annuity is defined as a financial vehicle that is designed to liquidate a principal sum, lump sum of money, systematically over the lifetime of the recipient, who we call the annuitant. The best way to die, financially speaking, is to die penniless, to die broke. Because think about it, when you're born, you come into this world with nothing financially. And when you die, you want to leave with nothing. Because if you die broke, two things happen. Number one, there's nothing for your family to fight over, right? Because you spent all that money, right? That bumper sticker when you're in bumper to bumper traffic that says, I'm spending my family's inheritance. That's what an annuity does. And then there's nothing for the government to tax. Well, we have different time periods on the annuity. So the annuities have first what is called the accumulation period. On all of our cash value insurance products, good testing point to know, our cash value, like in the life insurance policy, while it's accumulating, while it's under that insurance policy umbrella, and the same thing holds true here on the annuity, your cash value accumulates on a tax-deferred basis. And what tax-deferred simply means is that while your money is in the annuity product, under that annuity umbrella, that umbrella is shielding us from current taxation. So when we put that money in there, as the money is growing, as the money is accumulating and growing, whether it be interest rate, or we'll talk about variable annuities today, same definition as what you saw in the variable life insurance, you're going to have separate accounts that you could allocate your cash value to. Or we talked about equity index life, we'll talk about equity indexed annuities, which is sort of a hybrid of a fixed annuity, which is just creating a rate of interest, which is nothing to write home about right now because interest rates are so depressed, and a variable annuity. Now, the annuity insured, the insured on the annuity, we call that person the annuitant. The insured on the annuity is called the annuitant. That is the party to whom the annuity contract is on. So we have the accumulation period, it accumulates tax deferred, and then we have what is called the annuitization period. The annuitization period is, once again, my definition of annuity, your systematic liquidation of the lump sum of money. So what we want to make sure of is that that money does not outlive us, that we don't outlive our money. We want to make sure our money outlives us. Now, the different scenarios of setting up what is called a single payment or a single premium annuity. Someone who all of a sudden comes into a lump sum of money. So let's say you're in someone's will and you're getting an inheritance of $250,000, $500,000. Where are you looking to put that money? An annuity could be such place to put that money. Someone who wins the lottery. I keep checking my lottery tickets and my wife keeps yelling at me for picking the wrong numbers. I'm trying. Well, let's say someone is a recipient of a large lawsuit settlement. Where's the money going? There are what are called structured settlements. So when there's a medical malpractice award given to a plaintiff, the defendant's insurance company is not writing one big check for $50 million for that medical malpractice award. Instead, what they'll set up with the court are what are called structured settlements. Structured settlement simply means that 50 million is not going to be written as one check today. The 50 million is going to be paid out over a period of time. And that could be using the annuity for structuring those settlement options. So this way we know the money is going to get paid. When we annuitize, the money now becomes the insurance company's. So what you're doing when you set up what is called a straight life income option, what you're doing is you're saying to the insurance company, my concern is outliving my money. And here's what the insurance company says. If you're willing to forfeit your money to us today, in other words, this $1 million you have in your annuity, you're willing to forfeit that money to us, we could give you a guaranteed stream of income that you can't outlive, all right? But there are conditions, all right? It's a straight life income option. You got to be alive. So as long as you're alive, we're going to keep paying you out an income each year. Now, the insurance company is going to base that upon mortality statistics. So the older you are, think about this for a moment logically, the older you are, that means the shorter your life expectancy is going to be. What will that mean as far as the payout? It means it's going to be a higher payout. Males die sooner than females. So think about it logically. Because if we have a male that's 65 and a female 65, the actuarial statistics, the mortality statistics, the mortality charts are going to say that your risk of the female dying is going to be much smaller than the male. So being that the male, once again, has a shorter window of time to be paid, the male will get paid more money. Now, just like we saw on a life insurance policy, usually on annuities, your insured, who is our annuitant, and the owner of the contract are usually the same party. So you're insured, which we're calling on the annuity, the annuitant and the owner of the contract are usually the same party. But just like on life insurance, on the annuity, the annuitant, the insured, and the owner could be two different parties. So when the annuitant and the owner are two different parties, well, let's look at the powers or the rights of the owner. The owner could designate who they want as the insured, the annuitant. On an annuity, before a settlement option is paid, so while we are in the accumulation phase, should the owner or the annuitant die while we're in the accumulation phase, the owner needs to designate beneficiaries. And just like you saw in life insurance, you could have your primary beneficiary. That would be the beneficiary first in line. And remember, on life insurance, we said we always need to set up a backup plan, because what happens if our annuitant or our owner here in the annuity dies before, the primary beneficiary rather dies before the annuitant? Well, we need to set up a backup plan so you'll have contingent beneficiaries. The owner controls the money. What does that mean? The owner could decide, you know what, I don't want to keep this contract anymore. I want to surrender it and cancel it out. Or the owner may decide, I need to withdraw some money. So when we take money out of the annuity, it's a withdrawal or a cash surrender, or the owner has selected a settlement option for a systematic payout. Now, testing point. Is there a taxable event triggered when cash value of that annuity contract comes out? And the answer is yes, because annuities are considered LIFO. What does LIFO acronym stand for? Last in, first out. Well, remember I said just a little while ago that the cash value in the annuity grows on a tax-deferred basis. So while it's under the annuity umbrella, there's no taxation on our growth. But now when we're taking that money out away from the umbrella, it's no longer shielded by the contract, and now it's coming out, a taxable event will indeed be triggered. So the beneficiary receives the accumulation value if the owner dies, or if there's a settlement option and the annuitant dies. If it is a settlement option for which there could be a beneficiary, then the beneficiary will receive that money when a settlement option has been selected. The insurance company, the insurer, party number 2, is the party who issues the contract and backs the money if it's a fixed annuity. Now, a lot of times when we do bank classes, right, over the years I've taught at banks, and banks want to get their representatives insurance licensed, and they're saying, you know, I already have a securities license and I can sell IRAs, but why do I need an insurance license to sell the annuity? The reason being that you need an insurance license to sell the annuity is because annuities are issued only by insurance companies. So as I said, life insurance protects against dying too soon. The annuity is the mirror image, the inside out, the reverse. And what the annuity is looking to do, once again, is protect against the risk of living too long. Because of the technology and advances and prescription medications, better standard of living. You know, think about it. Everyone is complaining about being at home. Well, think about 100 years ago, a little over 100 years ago, when the Spanish flu hit in 1917, 1918. If you were at home, you didn't have Showtime and Stars and cable TV to turn on. You didn't have Xboxes and PlayStations to turn on, or even an internet. Basically, you had a book to read. That was it. So we do have better standard of living today. So the different kinds of annuities that we have, the way that we could fund the annuity. We have what is called the immediate annuity. The immediate annuity is only funded with one payment. And our acronym for the immediate annuity is SPIA, SPIA. SPIA is the acronym standing for Single Premium or Single Payment Immediate Annuity. When a SPIA is being set up, the individual already has the lump sum of money. And usually when a SPIA is being set up, the payout of that contract is usually going to start 1 month later after setting up the contract, but usually no more than 12 months after setting up the contract. So a good testing point to keep in your back pocket is on an immediate annuity. It's always funded with one payment. So we're not going to continuously put money into that contract. We're going to put in just one payment into the contract. And then 1 month later, no more than 12 months, the contract holder is going to look to start to get distribution from that contract. As compared to a deferred annuity, right? If you just read the words in their most simplistic form, and what I always say in every presentation that I provide, whether it was the live classroom or online, all you gotta do is read the words. And the more simplistic, the less sophisticated you are in reading words, the higher your probability will be of getting a question right. So immediate annuity, immediately looking to start drawing an income. A deferred annuity means we're not looking to take an income next month or next year, but probably far further into the future. Usually that would be retirement. Now, on the deferred annuity, there are several ways that we could fund it. We have what is called the SPDA. Our acronym SPDA means a single premium deferred annuity. SPDA, single premium deferred annuity. So we're just going to set up this contract with one lump sum payment. But as compared to the SPIA, the single premium immediate annuity, we're not going to look to draw out an income right now, next month, or within the next 12 months. Usually it'll be far further into the future, usually that being retirement. Now, some people don't always have that big lump sum. Where you'd write SPDAs or SPIAs, 401k, 403b rollovers will probably be the biggest one she'll write. So let's say right now, you all have a golden opportunity here. What's going on? 26 million people have been furloughed, laid off, or they've lost their job. They're now required to take their money out of their 401k, but they're too young to start taking an income. So why not have them do an IRA rollover? An annuity could be the perfect vehicle for them. But we have people that don't always have that lump sum of money. But what they're looking to do is they're looking to set up supplemental savings. So as I mentioned earlier, Social Security, retirement, unless there's some major changes to Social Security retirement, which I anticipate there will, the bottom line is you got to control your own destiny. So if we have someone who, let's say, has already maxed out on their defined contribution money, defined contribution plan, your good old traditional IRA, 401k, 403b, SEP, SAR, SEP, simple IRA. When you hear the words defined contribution, that means the government is only allowing you to put in so much money per year. So that being the case that we have limitations, well, here's what that person could do. They could set up supplemental retirement with a flexible annuity. So with that flexible annuity, the name implies that it's flexible. They can vary how much money they pay into the annuity contract. They can vary the frequency as well because it's flexible. The owner decides at some point in time in the future when they're going to actually annuitize the contract. All right. Usually that would be a retirement. What is retirement age? That will vary from person to person that you speak to. That could be 55, 50, 60, 65, 70, 75. I mean, my kids already have said, Dad, I don't know if I'm ever going to be able to retire. I said, well, as long as you started saving early, you don't need to save so much. And the magic of compound interest over time, you'll be okay. But unfortunately, so many people my age have not done the proper saving. I mean, quite honestly, I don't believe I have enough saved up for retirement. Luckily, I'm doing something I love. Luckily, Kaplan is going to be segueing into virtual learning, and I'm hoping I'll still have a job. Now, on the annuity, we can take a withdrawal. But when we take a withdrawal from an annuity, all right, we're talking about here now deferred annuities. The insurance company will have a surrender penalty period. But on that withdrawal, in other words, you're not getting rid of the contract. Many insurance companies will offer a 10% withdrawal where they will not hit you with a surrender penalty for taking money out. But the government, the IRS, is not going to be so kind. The IRS is going to say, well, you took money out of this policy, so we're going to hit you with taxes, because remember I said it's life of last in, first out. So they're considering the interest coming out first, not your principal. And then because you're taking that money out prior to 59.5, annuities follow qualified plan rules that say if you're taking a distribution prior to 59.5, not only are you paying taxes on your gains, but you're also going to pay a 10% penalty. But just like qualified plans, there are what are called hardship withdrawals. And a hardship withdrawal, I believe the coronavirus is one of them right now. But if someone were to die, obviously there's no penalty. I mean, the biggest penalty is death. But let's say someone were to get sick or disabled and need long-term care, or it's another hardship withdrawal on qualified plans, first-time home purchaser, educational funding. All right, so there are some hardship withdrawals, but if you don't qualify for a hardship withdrawal, you do have that 10% penalty prior to age 59.5. Now, the death benefit on the annuity, if the person dies, is different than life insurance, right? Remember, any of you that are on the life insurance call, remember said on life insurance, they said the death benefit is paid income tax free. On the annuity, that's not the case. On the annuity, what will not be taxable is if the annuity contract we were funding is a non-qualified annuity, right? What non-qualified means, test-taking purposes, non-qualified means the money you contributed or paid into the annuity contract was a post or after-tax dollar. So you already paid your taxes on that money you put in. But now when there's a death, the money you put in with after-tax dollars will not be taxable to your beneficiaries. Taxes have already been paid, but any of the growth or gains that accumulated, and they were accumulating tax deferred, those gains will be taxable. Good testing point to know. But let's say we used the annuity to fund our traditional IRA. A traditional IRA or a 401k is funded with a pre-tax dollar, and we were using the annuity to fund a qualified retirement plan. Well, it's going to follow qualified plan rules, which means that when that death benefit's paid out, all of it could wind up being taxable. So let's look at our settlement options, the different systematic ways of paying out the lump sum of money. These here, if they appear eerily familiar to you, well, guess what? I already talked about them last week when we were discussing settlement options on life insurance. Our definition of a settlement option.
That was Mom. She's on her way home.
Well, someone needs to be. Okay. I don't know, someone was looking to go home somewhere. Anyway, the settlement options here are the same as what we saw in life insurance. Once again, our definition of a settlement option is the systematic liquidation of a lump sum of money. Settlement option is defined as your systematic liquidation of a lump sum of money. Well, the settlement option that will pay out the greatest amount of income is what we call a straight life or pure life or life only. A straight life or pure life option has no beneficiary, because here's what you have. Will the test have the updated required minimum distribution rules? Well, unless your test is showing a 2020 updated outline version, all right? So what you want to do on Pearson View, PSI, thank you, Nicole, for giving me that heads up. On Pearson View, PSI, or Prometric, if your state outline was last updated in 2020, then yes, the new RMD rules. In fact, there is no RMD right now because of the coronavirus, but the RMD updated it to age 72 now, not age 70. But if it's still showing 2019, they're still testing on 2019 rules, all right? So when you go to sit for that state licensing exam, check the date as far as when your state exam outline was updated. If it was updated after January 1 of 2020, then it is going to use age 72 as your RMD. If it was updated last in 2019, it's still age 70. Okay, so that's why we haven't updated our slide yet. So on a straight life or pure life or life only option, what that's simply saying is that we're going to pay you an income for as long as you live. So you live, the insurance company pays. But once you die, payout stops. Well, your customer may ask, well, what happens with the remaining money that hadn't been paid out to me? That's the insurance company's money. Because what you did when you went with a straight life or pure life or life only option, you automatically have forfeited your lump sum of money in your annuity. And in exchange for forfeiting that lump sum of money of the annuity, insurance company says, you're not going to outlive your income. We're going to continually pay you for as long as you're alive. But as soon as you die, the payout stops. So here's a sales opportunity for all of you. If someone's selecting a straight life income option, unless they hate their family, someone who has, let's say, medical problems, big medical problems, is not going to select a straight life income option unless they hate their family. So guess what that's giving you an opportunity for? Sell them a life insurance policy. Why? Because when that person dies that selected a straight life income, when they die, payout stops. Well, what happens with life insurance when there's a death? Payout starts. So where it stops over here on this settlement option, you back it up with life insurance, that's your safety net, that will replace the income that's now lost to that family. But you got to be very careful with that straight life income option, because once there's a death, that's it. A lot of times people are attracted to that option. Why? There's no beneficiary, and it's going to give the greatest amount of income based upon the annuitant's age and gender and the amount of money that they have and the interest rate factor that the insurance company is using. Or what they could do is they could set up what is called a life with refund certain, or what we call a straight life with refund. If you remember it from life insurance, the settlement option, you already know it here, but let's go through it again, just to make sure we know it. On your state exams, lots of questions on settlement options, because settlement options could be tested for life insurance beneficiaries. Settlement options can be tested here now on annuities. So you want to know them verbatim. So on a life with refund, the refund could be set up in one of two ways. It could either be set up as a cash lump sum refund. So for example, let's say I started out with $1 million. I selected on my payout on my annuity a straight life with a lump sum refund. Well, if I started out originally with $1 million and at my death, they only paid out $400,000, well, that means there's still $600,000 that wasn't paid out from that contract. If it is a lump sum refund, that means the beneficiary will receive a $600,000 check. Or if it's set up as an installment refund, what that would mean is the insurance company will pay out the remaining $600,000 in installments until it's been fully paid out. Now, let's say I set up a life with a refund certain. My original starting amount was $1 million. At the time I died, $1.3 million had been paid out. Well, that means I beat the insurance company at their game. They wound up paying me more than what I started with. So if they wound up paying me more than I started with at the time of my death, that means there would be no refund, installment or lump sum, to the beneficiary. Or we could set it up as a straight life with a period certain. Now, when I add a period certain onto the straight life, once again, straight life, a life only, a pure life means you live, insurance companies pay. You live, they're going to continue to pay. They're going to base that income on your mortality statistic. What's your age? The older you are, the less years they potentially are going to pay out, higher income. Males die sooner than females, shorter potential life expectancy, so males are going to get paid more. But now let's say I add on here a 10-year period certain to the straight life. Here's what the insurance company is saying. They're saying to me, Paul, we're going to pay you the longer of how long you live, but for no less than 10 years. We're going to pay you the longer of how long you live, but no less than 10 years. So let's say I die after 1 year. Well, they said they were going to promise to pay 10. Well, if they already paid out for 1 year, that means they're going to pay out another 9 years to my beneficiary. If I died at the 5th year, the 10-year certain is greater than 5 years that they paid out. Insurance company will pay out the remaining 5 years. I died at the end of the 9th year. The 10-year certain is still greater than 9. They're going to pay out 1 more year. Now, if I'm still alive at the end of the 10th year, remember I said the insurance company is going to pay the longer of how long you live, but no less than the 10 years. So that means the insurance company will still continue to pay me, and they'll pay me for as long as I'm alive. But once I die, after the period certain has been completed, then there's nothing more to be paid out. Now, let's say instead of going with a 10-year period certain, I set this up with a 20-year period certain. So just think of this logically. I still have the same $1 million, but now the insurance company is saying we'll guarantee the payout of that $1 million over a 20-year period. Well, if they're looking to pay out the money, think about it, for a longer period of time, I still have the same amount of money. Well, that's going to mean we need to stretch out that money for 10 more years when we go 20 years certain. Well, if you guess that that means the payout's probably going to be lower, you guessed correctly, because we still have the same $1 million. So let's say after 1 year, I die. I now have here a 20-year certain. Well, 20 is greater than 1. They're going to pay out 19 more years to my family. I die at the end of the 5th year. 20 is greater than 5. They'll pay out 15 more years to my family. I die at the end of the 9th year. 20 is greater than 9. They'll pay out 11 more years. Now, let's say I died at year 15. On the 10-year certain, insurance company says, hey, we've met our contractual obligation of paying the longer of how long you live, or 10 years. You live 15 years. We don't have anything more to pay out. But let's say now I went 20 years. So now if I went 20 years, 20 is greater than the 15 that was paid, 5 more years would be paid out. These are important testing points to know. So once again, if the period certain had not been completed while I was alive, it will be completed at my death to my family. But should it be completed, that means there's nothing more there's no more of an obligation for the insurance company to pay, because they paid out their contractual obligation, the longer of how long I'm going to live, or my period certain, right? Lots of questions always tested on this. Or I could set this up as a joint and survivor. So joint and survivor means I'm going to get paid for as long as I'm alive. I live, insurance company's going to pay. I die. Well, now when I'm setting up a joint and survivor payout option, the insurance company is going to continue to make the same payment to my wife. So now what they're doing is they're taking two people's life expectancies. Well, my wife is 6 years younger than me. My wife is female. So if you look at mortality statistics, what does mortality say? Younger people are going to live longer than older people. Females are going to live longer than males. See, I'm the old man. So the old man's going to die sooner. She's the young lady. She's going to live longer. But now when we take a blended life expectancy, that means potentially insurance company could be paying out that much longer. Now they'll pay out as long as one of us are alive. But as soon as both of us have died, I should say, as soon as both of us have died, the insurance company fulfilled their contractual obligation and no money is going to be paid out. Now, sometimes we could set up what is called a joint life annuity. So a joint life annuity is going to have two annuitants on one contract. So remember we talked about joint life insurance, AKA first to die. So a joint life annuity here is a first to die annuity. So we have one annuity contract with two annuitants. Insurance company says, we're going to pay both of these annuitants as long as they're both alive. But as soon as one of these annuitants die, insurance company washes their hands clean and no more payments are going to be made. So here are the factors that are going to impact the payout of an annuity contract. Once again, age is a factor. So the older you are, the greater your risk of death is. And because you have greater risk of death as you get older, you're going to get paid more. So if I'm 63 years old and my wife is 56 years old, she'll be turning 57 this month. She'll kill me for telling everyone that now. Sorry. It's better than being 63. So here's the bottom line. She's 6 years younger than me. So that means potentially she's going to live longer due to age. She's also female. Females have longer life expectancy than males. So that means her payout's going to be less. My payout would be more. What kind of guarantee period are we selecting? So if we have just straight life, that means that they're going to pay out for as long as I'm alive. At my death, the payout stops. There's no beneficiary there. So being there's no beneficiary, I'm taking a lot of risk selecting that option. In exchange, my thought process is I'm going to beat the insurance company at their game of mortality. Well, insurance companies aren't dumb. So what I want to do, if I'm selecting a straight life income option, is back it up with life insurance, unless I hate my family, which I don't. I love my family. I miss my family. So I back it up with life insurance. Or let's say I have health issues and I can't qualify or I don't want to buy life insurance, then what I would want to link to that straight life option is a period certain, so there'd be a guaranteed period of time for payment, or a refund where whatever was not paid to me will be paid in a lump sum or installments to my family. or I could have it paid out to both myself and my wife. By the way, on that joint and survivor, now when we put my wife on there, 6 years younger and female, it's going to significantly reduce the payout. So here's what we could do. We could set up that joint and survivor where I get paid more money on the front end. She gets paid a lesser amount on the back end. Now that works. Here's why. When both of us are alive, we have two people's maintenance needs we need to address: food, shelter, clothing, and medical care. I die, it's only one person's food, shelter, clothing, and medical care that we need to address. So we'll get more money paid on the front end, joint and 3/4, joint and 2/3, joint and 1/2 survival. More money on the front end when two people's maintenance needs are needed to be addressed and paid for. Less money on the back end. And then what's the interest rate assumption that the insurance company is using? Some of our annuity products. So someone that has just a life insurance license can sell a fixed annuity. Someone who has a life insurance license can sell a fixed annuity. Testing point. When someone purchases a fixed annuity, that annuity contract is backed by the insurance company and the financial strength of that insurance company. So your cash value is going to be held in the general account of that insurance company. It's going to be held in the general account of that insurance company. So as long as that insurance company is financially strong, once again, check with AM Best, Moody's, Standard & Poor's, Duff & Phelps, Weiss Research, Standard Analytical. Look at what their rating is by those independent firms that give a grade to insurance companies. Dealing with an A++ company from AM Best, say you're in pretty good shape. But of course, people say, well, what happens if the insurance company goes out of business? We do live in a very unique, different world today. So what you want to do is check on your state law supplement. By the way, if you notice, we're not getting state specific on these calls. So check your state law supplement. And the majority of states do have what is called their state guarantee fund or state guarantee corporation. What the state guarantee fund, the corporation does, and once again, it will vary from one state to the other, so please do reference your state law supplement that we provided you from Kaplan. Should that insurance company get into financial trouble and they cannot honor the financial contractual obligations of the insurance policies they'd issued, the guarantee corp will take over those contracts, and depending upon what your state requires, there'll be so much money protected by that guarantee corp. And they'll protect it until they could find a insurer who'd be willing to take over the financial obligations. Annuities are not FDIC insurance, Federal Deposit Insurance Corp. Let me repeat that. Annuities are not FDIC insured. So any of you on the call that work in a bank, and you're going to be sitting in that bank building, that bank storefront, selling annuities, you're always going to have plastered all over the place on that desk that any products you're buying from this desk as an insurance product or investment product is not FDIC insured. It's not going to be FDIC insured. Excuse me. Your money is guaranteed by the insurance company. So on a fixed annuity, they're going to have two interest rates. They're going to have the current interest rate, and they're going to have the guaranteed minimum interest rate. Now, because Fed funds right now are literally at zero, the spread between the fixed interest rate that's guaranteed and the current is very, very minimal. Current interest rates, you gain 1%, there's a lot. The guaranteed minimum, probably the same 1%. Not getting much right now. But your money is protected by the insurance company. So the risk that you're taking when you're in a fixed product, the risk you're taking is you are taking on inflation risk. And with all this money that the government is handing out right now, I suspect we're going to see some inflation at some point. So yeah, your principal is protected. Yeah, you gain 1%, but are you going to be able to buy the same products and services in the future? Chances are you probably won't. So what people need to consider are what are called variable annuities. A variable annuity, testing point, requires that you have not only your insurance license, but you also need to have your securities licenses. Series 6 with a Series 63 or Series 7 with a Series 63. So if any of you on the call right now are securities licensed, well, you can sell your securities products, but you can't sell any insurance product because you need your insurance license. Any of you that have an insurance license without a securities license, you cannot sell variable products. Variable products are securities. They are regulated by two regulatory bodies, State Insurance Department and the federal, which is your FINRA. What distinguishes the variable annuity is the money that you're putting into that contract. You are going to be purchasing accumulation units of the separate accounts that are in that variable insurance product. So in other words, unlike the fixed product, the fixed product was guaranteeing your principal and guaranteeing your rate of interest. On your variable annuity, your money is going into the separate accounts. So that means the policy holder, the owner, is assuming all the risk of performance. Can you lose all your money? Yeah. But some insurance companies, or most insurance companies, I should say, that sell variable products or offer variable products, we're selling them, they do offer a guaranteed death benefit. But that's only good if the person dies. If the person sees a market downturn like we're in right now of 30 or 40%, and they say, oop, I better abandon ship and surrender my policy, you're going to get what the current value is of your contract when you surrender. And if you're doing it too soon, you'll also be hit with a surrender charge. So you're buying accumulation units. The old investment 101 says we should do what? Buy investments at a low price and in the future sell them at a higher price. That's what investment 101 does. But there are no guarantees here. There could be a guaranteed death benefit of what you originally put in, but there is no guarantee as far as a rate of return, or if you were to surrender your contract, you're only going to get what the value is at the time of surrender. We also have what are called equity index products. Equity index products are unique in that they're combining the best of both worlds of a fixed annuity and a variable annuity. It's going to tie its rate of return to an equity index like the S&P Standard & Poor's 500 index. So it's going to give you the guarantees of a fixed product. Your principal is 100% protected, and it's going to give you a guaranteed minimum interest rate return, let's say 1%. So right now the S&P 500 is down what, 35, 40%. At the end of 2020, your principal is 100% protected in the equity index, the annuity, and you got a positive 1% return. But last year when the markets were doing very well, and the S&P 500 was over 30%, I believe, or 20-something% last year. Well, if you weren't willing to participate this year when it's a bear market, an equity index product is not going to give you full participation in a bull market. In other words, there's going to be a cap or a ceiling, maybe 5%, 5.25%. So if the S&P 500 last year had a 30% return, you only gained the 5.25%. If this year it's down 30%, you still gain +1. Now, it's very interesting with equity index products is it only requires that you have a life insurance license. It doesn't require securities license because you're not giving investment advice to the customer. You're just saying it's tied into the S&P 500 index. Here's the best you could do. Here's the worst you could do. So you're really not giving investment advice. We also have what are called MVAs, market value adjusted annuities. These are annuities that are looking to compete against that person that has a whole bunch of different CDs. They set up what are called laddered CDs, where they're going to have different maturity periods of their money in the CD. So not just putting their entire balance of money into one CD as a 7-year or 5-year CD. They're going to take a percentage of their money, have the CD mature in 6 months, 12 months, 24 months, 36 months, 5, 7, 10 years. The MVA could do just the same, where we could offer different interest rate or rate of return guarantees over different time periods. Here's a comparison, comparing your fixed versus variable, immediate versus deferred, and your different payout options. Now, our temporary payout option on the annuities is our period certain or fixed period or a fixed amount. So remember, we talked about that on life insurance on settlement options. So we do a 10-year period certain. It doesn't matter what our age is. It doesn't matter what our gender is. We're requesting from the insurance company that we want to liquidate that lump sum of $1 million over 10 years. So on that 10-year certain or fixed period, what we know is how long we'll get paid. What we don't know is how much, because interest rates are going to fluctuate from one year to the other. So let's say I have $1 million that I had set up a 10-year certain or 10-year fixed period. I die after 1 year. 10 is greater than 1, 9 more years will be paid to my wife. I die at the end of 5 years. 10 is greater than 5, my wife gets paid 5 more years. I die at the end of the 9th year. 10 is greater than 9, my wife gets paid 1 more year. Now, what happens on a 10-year certain? Once they pay me out for 10 years, I've now depleted my lump sum of money. And now how do I survive? So that's why we're calling it a temporary annuity, because once the period certain has been completed, the insurance company has fulfilled their obligation for payout. Now you may say, well, instead of doing 10-year certain, Paul, why don't you do a 20-year fixed period or a 20-year certain? I can do that. But just think about this logically. It's very simple. If I now still have the same $1 million, and I'm saying to the insurance company, I want to get paid for 20 years instead of 10 years, well, that means they got to stretch out the money for a longer period of time. Guess what that's going to mean? A lower payout to me. Or I could set it up as a fixed amount option. Fixed amount simply means what it says. I have $1 million and I say to the insurance company, I want to get paid $10,000 a month. So what will the insurance company do? They'll pay me out $10,000 each month. How long will they pay me that money out? For as long as the money lasts. But once they paid out my $1 million, insurance company says, we're done. We fulfilled our contractual obligation. It's a temporary annuity, just like the fixed period, because once my lump sum has been paid out, game over. That's it, done. They fulfilled their contractual obligation. So it didn't matter whether I was setting up that fixed amount or my wife was setting up the fixed amount, because it's not based upon mortality. That's why we're calling it a temporary annuity here. Different uses of annuities. An annuity, once again, could give you an income you cannot live. And people are looking for guarantees right now. You know, all you need is a downturn in the market. Everyone's like racing to guarantees. You have your money growing tax deferred. You have two accounts, one growing tax deferred, one going tax free, or taxable, I should say. Over time, the tax deferred is going to have more growth. Annuities are sometimes used to fund a qualified retirement plan. Annuities sometimes are used to fund college education. On a group annuity, this is annuity that's funded by the employer contributions. You know what they call the retirement system that teachers participate in? TSAs. You know what TSA stands for? It's not the Transit Safety Administration. TSA stands for tax sheltered annuity. So guess what their retirement system is using to fund for retirement? If you guessed annuities, you guessed correctly. The distributions will be determined by the employer. So let's talk about group life insurance. So the advantages of group insurance is that with group insurance, many times the medical underwriting will be far more relaxed than buying it as an individual. But in order to set up group insurance, it must be what we call a natural group. And a natural group simply means that the group insurance is secondary to why it's being set up. So we're not buying the group insurance for the sake of getting a better rate. We already have a group already established, an employer group, a union, a non-for-profit, a religious organization, a professional organization. So because we already have a group that's been established, being a member of that group now, you may be able to get a group-like benefit. Sometimes we have set up multiple employer trusts, METs. We have people who are of the same industry. And instead of setting up their group insurance for themselves, they join into an association or a union, and you have mass numbers of small businesses getting together. Well, it's like anything that you buy. When you buy in mass quantity, so if I go into Costco or Birkin Jensen's Wholesale or Sam's Club, one roll of Scott toilet paper in the supermarket, I'll probably pay $1.50, $2 when it was scarce. But if I go into Costco, all right, I was saying to my wife, I said, we have a year's worth of toilet paper here. Unless you have your kids. And when we had the kids living home, we went through toilet paper like crazy. So it's like anything. If you buy one, you pay the one price. If you buy mass quantity, what happens is your unit value price goes down. Now, on the Mets on group insurance, it must be part of the Taft-Hartley Act, especially labor union, because the Taft-Hartley Act is simply requiring that it not be the union control the money, but rather there be a TPA, a third-party administrator, controlling the funds. Once again, professional trade associations, group credit life. Now, when group insurance is set up, testing points. The sponsor of the group plan receives the master policy. The members of the group, the employees, they receive a certificate. Always remember, it's the master policy holder, the employer, who controls that contract. So they pick which insurance company they want to go with. They pick what benefits they want to have offered on it. They set up the eligibility requirements. And most group insurance plans use the Affordability Care Act model of group insurance, which says to be eligible, number one, you need to be a full-time employee. Full-time employee under the Affordability Care Act model says you need to work on a regular basis 30 or more hours a week. They also can have a waiting period. Affordability Care Act says that you are eligible to come on a group plan the first of the month following 30 days of service to the employer. Many group insurance plans do the same. But they can't discriminate because group insurance has to honor ERISA, the Employee Retirement Income Securities Act, saying there cannot be any discrimination. Any protected category, age, race, religion, skin color, language, country of origin, disability, sexual orientation. But they could set up legal, what I call discrimination or eligibility requirements. So once again, the employer receives the master policy, the employees receive certificate. Now, years ago, when the cost of doing business was not at the cost we see today, an employer would set up non-contributory plan. Percentage I want you to know for your test, 100%. So non-contributory plan, 100% means that all of those eligible employees, their eligible dependents, have to be offered the plan. But because of all of the regulations and costs of doing business today, watch what happens with restaurants now. They're going to have to sanitize their menus, or maybe they're going to all go to paper menus. This way you order and they throw it away. Or maybe, I know I've gone into Texas Roadhouse where you could actually order your meal, even before the coronavirus, you could order your meal on your phone, or they have an iPad on the table, and you could also pay on your phone or your iPad. But with a contributory plan, what that means is the employees are going to have to participate in the premium payment. When you see contributory for test taking purposes, we need 75% participation of the eligible employees and the dependents on the plan. As I mentioned, group underwriting is going to be more relaxed and not as rigid as individual. So many times on group insurance, up to certain limits, death benefits rather, there are no medical qualifiers, no medical exam, no medical questionnaire. You're an eligible employee, have eligible dependents, sign up, you got coverage. Okay. Now, every group plan is always going to have an annual open enrollment period. That means that if you opted out originally, you could opt in. Usually that open enrollment period is the last calendar month of the calendar year. So that means December is going to be that open enrollment period if you opted out. And when you exercise in open enrollment period, it's like as if you were coming on new. It's not going to be any medical questions asked. Okay. If it's a late enrollment, then there could be medical questions asked. We could also cover dependents. So once again, someone that has medical problems, right? And I always get that call, you know, someone's looking to buy life insurance. Paul, when can I see you? Right? Of course, right now we can. But before the coronavirus, when can I see you? And it would always be a red flag to me. All right, what's wrong here, right? Well, you know what? I was just diagnosed with this disease, or I just had open heart surgery, or just finished cancer treatment, or the wife or the kid. You know, and it's always heartbreaking to tell people you can't write insurance for them. Now, there are guaranteed issue contracts out there, but if it's on a group, many times the group will be on a guaranteed issue basis. As long as you're eligible or an eligible dependent, you get coverage. Now, on group insurance, we also have conversion. Conversion is where we go from the group term plan to individual permanent insurance. Testing points. Conversion's usually going to be a 31-day window of opportunity from when a qualifying event is triggered. So let's say your employer stops the plan, or I was afraid to answer my cell phone last week because it was like every other call, someone lost their job up in New York. Scary right now. So they're offered conversion, right? They're offered 31 days for that conversion. The conversion will be at their attained or actual age, attained age or actual current age they are at the time of conversion. But here's the big benefit of conversion. No medical qualifiers, no medical exams, no medical underwriting. Now, if the person did not exercise conversion and we're still in that 31-day window of opportunity, they still have full insurance coverage provided by that insurance company's plan. On the credit life insurance, so on the group credit life insurance sponsored by the lender is going to be the beneficiary. Because it's grouped as little or no underwriting, it will be cheaper than buying it on your own. Now, the amount of insurance can never be greater than the outstanding debt at the time of death. So credit insurance, sometimes mortgage insurance, is nothing more than a decreasing term. So if you're taking out a loan, you're borrowing money, you're taking out a mortgage, as you make payments, your principal you owe is going to be reduced. So at the time of death, whatever the outstanding principal is what the policy will pay out on. So if originally we had a $25,000 loan, and at death you owe $20,000, only $20,000 is going to get paid out as a decreasing term. If it's individual credit insurance, then you're the policy owner. You can assign the death benefit to the lender. But when you're buying your own insurance, once again, you control the policy. Because you're buying an individual policy, it's going to be more expensive, could require underwriting. So where the group insurance is more favorable is if it's an older borrower or an individual who would not be able to qualify for life insurance that's medically underwritten. Our retirement plans. Now, once again, as I had mentioned, if the update on the outline, your state outline, is prior to January 1st of 2020, then they're still using 2019 rules and regulations. But I'll tell you on your state exams, with regard to the taxation and the retirement questions, most states that I've taught in, I've taught all over the country, it's a very small percentage of your state licensing exam. So don't spend an abundance of time studying retirement plans and taxation on life insurance, right? Don't spend a lot of time on it. So what we'll hit on here are what are the most frequently testing points that candidates see. Now, in order to contribute to a IRA, a traditional IRA account, you must have earned income. If your income is pension or dividend income, that is not earned income. And earned income means you're going and doing a job and being paid for doing that job. If I'm getting dividend income from a stock, the only job I'm doing is having that stock. Or if I'm getting a pension income, I'm not working anymore for the pension. Yeah, I had to work hard to get the pension, but I'm not working now to get that pension. So it's got to be earned income. If you're filing a joint tax return, your spouse that is at home, Your spouse is doing a job still, right? I can tell you that when my wife was home with our kids when they were little, I would tell her every day when I left for work, you're doing the more important job. All right. And I got to tell you, my wife did a fantastic job. I tip my hat to her. It's not easy raising children today. Lots of challenges today, and different challenges than when I grew up. Very different challenges. But by filing a joint tax return, she could contribute also to her own IRA account, even if she's not working, right? But we do need to have one spouse earning income, all right? And that was me. So I can contribute to my IRA up to certain limits. These are defined contribution plans. So I can contribute $6,000 if you're under age 50. The last time I looked at my wallet, I have an AARP card, so that means I'm over 50. So if you're over 50, the government allows you to make an extra contribution to your IRA, which we call a catch-up contribution. And I can put in another $1,000 of $7,000. My wife, she hates that I keep reminding her. She's also over 50. So she could put in $6,000 and she has a catch-up for another $1,000. Now, what happens with IRAs is the deductibility starts decreasing or being phased out if you are a single taxpayer. If you're a single taxpayer, then once you hit 65,000, the deductibility of your IRA starts decreasing. And once you go over 75,000, that's the maximum adjusted gross income. You can't contribute. Well, you can contribute, but it's not deductible. So that being the case that it's no longer deductible, then what you would want to do is go into a Roth IRA. And if you're filing a joint tax return, once you go over 124,000, you don't need to know those numbers, not important for tests. But once you go over certain limits and you lose your deductibility, then what you may want to look at is doing a Roth IRA. Now, IRAs, this is a good testing point. IRAs cannot be invested into life insurance, artwork, antiques, stamps, coin collections, or gold or silver bullion. If it's a U.S. minted coin, that's okay. It's U.S. minted coin. Now, the 59.5 rule is always tested. And what the 59.5 rule says is if you take money out of a qualified retirement plan prior to your normal retirement age of 59.5, they consider, then there's a penalty of 10%. Plus, you're still paying the taxes, right? Plus, you're still paying the taxes. So on our retirement plans, they do forgive you, all right, or what they call a hardship withdrawal that you have over here. Down payment of a first home, college education, health insurance premiums if you lose your job, certain types of medical expenses, the coronavirus right now, they're not getting you with the 10% penalty, but you're still paying taxes. All right, a lot of people don't realize you're still going to be paying taxes. You are allowed to do one rollover per calendar year. As far as transfers, you can do as many transfers as you want, but you only do one rollover. Now, usually when someone that's doing a roll, taking money out, your plan sponsor will usually withhold 20%, so this way you're not hit with a big tax bill, right? But it's one rollover per calendar year. Transfers are unlimited. See, we did update this, all right? So your RMD 72 now, all right? So we did update this, so that means your 2020 test will have the 72 as well. withdrawals are going to be fully taxable. Why? Because the money you put in, you didn't pay tax on. The money that grew your retirement plan, you didn't pay tax on. So that means all of it is going to become taxable. So we do have distribution upon death. The spouse could choose to treat the IRA as their own and set up what we call a spousal IRA, which means they would still defer the taxation. Non-spouse beneficiaries could pay out over a 10-year period. Now, because you own the IRA, it is going to be includable in your estate, which means it could be estate taxes. Don't confuse estate taxes with death taxes. Estate taxes are when the estate goes over certain thresholds, and unless it's going to a surviving spouse, if it's someone other than a surviving spouse receiving it, that means there'll be an estate tax liability. And that's usually 9 months after the death of the individual. The Roth IRA, the highlights of the Roth IRA is the Roth IRA is paid with post or after tax dollars. So you're not going to get a tax deduction up front like you do on the traditional IRA. But here's the highlights of the Roth IRA that's frequently tested. Number one, as long as you hold the Roth IRA for more than 5 years, and as long as you're not taking that money out prior to 59 and a half, there is no tax triggered on a Roth IRA. There is no tax triggered on a Roth IRA. Also on a Roth IRA, there is no required minimum distribution. So that means that you can leave the money there, and at your death, it goes to your family. There'd be no income tax, but there still could be an estate tax. All right, I already talked about ERISA. So what ERISA deals with is making sure that a retirement plan is not what we call top heavy. A top heavy plan simply means that the plan is really benefiting more the higher ups, the higher compensated employees. So when an employer is filling out a 5500 form, which you do on a group retirement plan, if the plan is top heavy, then either the employer has to reduce what the higher compensated are contributing, or they have to bump up what they're contributing to the lower compensated employees. All right, and of course it's checking for discrimination. It also is making sure that there's a vesting on the plan. So an employee is always vested 100% in the money that they're putting into their retirement plan, right? So if I'm contributing to a retirement plan, anything I put in, I'm 100% vested, it's my money. But when it's an employer contribution, with employer contributions, they could set up a vesting schedule, the employer, but the employees have to be vested in at least 6 years, right? And there's all different rules and things they could do. Once again, your state licensing exams do not get that technical. A continuing education course might, but pre-licensing, no, they're not going to get very technical here. All right, they have to have a fiduciary that's watching over the funds to make sure no one absconds with that money. Okay, defined benefit. Defined benefit are very rare, right? And this is what's gotten a lot of municipalities in trouble. A defined benefit is doing what it says. The retirement plan is saying to that employee, as long as you put in certain amount of service with the employer, we are going to guarantee you a certain amount of income for life or a certain number of years. Well, being that so many municipalities are cash strapped and dealing with a low interest rate environment and dealing with people living longer today. When I came into the insurance business in 1985, here's what retirement planning was. You made sure someone had enough money so that at 65, they had 13 to 15 years of income, then they died. That's not retirement planning today. So with the defined benefit, the employer has to participate each and every year, which is why many plans have gone to defined contributions, your 401k. The defined contribution plan, we know how much we can put in, but what we don't know is what's going to come out in the future. Whereas with the defined benefit plan, we know what's going to come out in the future. What we got to put in right now, a lot of municipalities have to pump in a lot of money that literally they just don't have. The profit sharing plan, the employer has the option of putting money in or not putting money in. Unless you're in a very unique business this year, I'm sure there's not going to be a lot of profits. So that means on the profit sharing plan, if there is no profit, guess what? The employer does not have to put money in. Keogh plan, this is offered to self-employed individuals. So the Keogh plan will allow the individual to put in a lot more than if they were setting up a traditional IRA account or even a simple IRA account. So they can set up their Keogh as defined benefit. You're self-employed, you could do that, but they're probably better served setting it up as a defined contribution plan. And then the most popular of the retirement plans, the 401k. 401k is a defined contribution plan. If you're not in your employer's 401k plan, you want to participate in it because many employers, to encourage participation, will provide a match for what the employee is putting in. So if your employer is saying, well, we'll match up the first 5% you put in, you just got a 5% pay raise and you did nothing better than you're already doing just by enrolling and participating in the 401k your employer is setting up. 403Bs, not-for-profits, hospitals, educational employers. The limits are going to be the same as the 401k limits. It's just because of the employer structure, the IRS says they're not eligible for a 401k. Sometimes a small business could set up a SEP, a simplified employee pension plan. They may want to do that because there's less administrative costs as compared to the 401k. It also allows you to participate or contribute more than a traditional IRA account. On the SEPs, the employer can also match. Okay, ERISA I talked about already. You could also set up a non-qualified plan. Guess what we can use for the non-qualified plan? What we decided our discussion today with annuities. Our income tax treatment on life insurance. Premiums are not deductible. I know I'm going to go a couple minutes over here. It's okay. Premiums are not deductible. Your benefits are not taxable. Your cash grows tax deferred. All right. So testing points. Death benefit, if it's someone who could take receipt of money, income tax free. Premiums on life insurance, not deductible. The only time we see deductible is group life insurance for the employer. Cash value grows tax deferred. If we surrender the policy, all depends on what we put in. If we're getting more than what we put in, going to trigger a taxable event. If we get less, well, it's not an investment, so there is no write-off. A withdrawal is considered FIFO, first in, first out. So withdrawal, there is no taxable event because they consider the after-tax premium coming out first. Loans are also not taxable. A loan is defined as taking money out with the intent on putting it back in. Dividends paid in cash are not taxable. It's a return or refund of your excess premium. Accelerated benefits are not taxable. We talked about that the other day. Once again, premium on life insurance, business life insurance, the only ones that are taxable income are your executive bonus for the employee. All right, so once again, premiums by the employer could be tax deductible, are tax deductible rather on the group. Premiums paid by the employee, so it's a contributory plan. The employee's premiums are paid with post or after tax dollars if they're doing it as a payroll deduction. Now, regardless of who's paying the premium, the death benefit is not taxable. Now, here's another bullet that's frequently tested. Employer paid premium for life insurance, for group life insurance, for death benefits above and beyond $50,000, that premium that is paid by your employer is going to be taxable income to the employee, which is why a lot of employers limit their payment for your premium on your group life insurance to the $50,000. So if they're paying the premium for the first $50,000, that's a free benefit to you. For usually the supplemental life insurance, they'll usually have the employees pay for that, and that will be paid with an after-tax dollar. But if you have a nice employer who's providing you $250,000 of coverage, the premium that employer is paying for death benefit in excess of that $50,000 will be taxed as income. So, for example, let's say $50,000 of coverage costs for the employer $200 for the year. $250,000 is going to cost $600 for the year, and the employer is paying it. Well, that $400 that's buying the coverage above that first $50,000 will be taxed as ordinary income to that employee. Modifying endowment contract, policy that fails the 7-pay test rule. That policy that fails the 7-pay test rule, when they take money out, it's going to be treated like an IRA. Last in, first out, and it could be hit with the 10% penalty. The death benefit, though, still has all the advantages of a life insurance death benefit. Income tax free, bypass probate, creditor proof, and quickly pay dollars if that contract is incontestable. The annuities we talked about already. The 1035 exchange. This here is important to know for your test. 1035 exchange means you're requesting to have the cash value of your life insurance or annuity contract be directly transferred by your insurer to the insurer issuing the new insurance contract. Now, 1035 always allows us to go from a like-to-like product. And as long as it's a direct rollover from one insurance company's policy to the other, in other words, you're not touching the money, that money is not hitting your hand, the tax-deterred growth of the original contract will go into the new contract. So I could go life to life, I could go annuity to annuity. Now, I can go life to annuity, but I can't go annuity to life. Here's why. We could get money out of a life insurance policy, cash value that is, without a taxable event by taking a loan, or if it's a universal life, a loan or withdrawal. On an annuity contract, which we discussed today, on an annuity contract, there's always going to be a taxable event when cash value comes out. Because remember I said it's life or last in, first out. So they'll allow it life to annuity because you're going from a product where there wouldn't be a taxable event into one there is a taxable event, which is the same reason why annuity to life does not qualify under 1035. Because now you would be going from a contract where there'd be always a taxable event, where there'd be one where potentially there wouldn't be a taxable event. So the way that I remember it, I moved down here to Atlanta. I'm not going to go back to Atlanta to Long Island. That's where I lived originally. I'm not going to go Atlanta to Long Island. Annuity to life. I can go Long Island to Atlanta, which is what I did. I know it's stupid, but you know what? If I could help you remember something, and that one question you get right helps you pass your state exam, then we've done our job here. Okay, estate taxes are your death taxes. Income taxes are your taxes, except for this year, obviously, that are due April 15th. Okay, I am done here. So I thank you all for staying on the call with us. I'm going to leave it open, the webinar, for a couple minutes for Nicole to answer any additional questions that you may have. I'll be back here tomorrow. Which one was first in, first out? The universal life policies on the withdrawals are first in, first out. Okay, so I'll be back here tomorrow at 10:30. We're also going to do another 90-minute session. So tomorrow we're going to be going into the accident and health, or accident and sickness. Okay, ladies and gentlemen, happy Monday to you. And I'll see you back tomorrow. Have a great rest of the day. Bye-bye now. All right, Nicole will answer your questions.